Good morning. You might be concerned that the governments benefit from all your hard-earned savings and investments and not your family. You might be worried about how complex the rules around inheritance tax are and the potential solutions. And you might not know where to go for a local level of face-to-face service. Well, I'm Richard Higgs from Harold Stevens. We are later life financial planning specialists right here in West-Brontrim on the High Street. We are accredited with SOLA, the Society of Later Life Advisors, which is really the gold standard in advising older people. And we've won national awards for the way we deal with clients in vulnerable circumstances and clients in later life. So I'm here today to talk to you about inheritance tax planning. It's a bit of a inheritance tax planning 101, a very brief overview of some of the options. But remember, there's over £7 billion now paid in inheritance tax per year, which is a huge amount of money. I can see why it's the most hated tax in the UK. I think the average bill now is inheritance tax bill per person is just over £200,000. And remember, it really is a choice. You know, there are planning arrangements that you can do in lifetime to reduce or even eliminate the inheritance tax that the family might have to pay. So it really is all about kind of taking action. So hopefully this video inspires you today to take action and to look at some of the options available to you. So let's just quickly go through the how you work out or how you calculate whether you've got an inheritance tax potential liability. So really the first thing to do is add up all of your assets, excluding any personal pensions that you have. So properties, second homes, ISAs, investments, national savings, bank accounts, any assets that you have, add up everything. And that gives you a total asset value of your estate. So each individual person gets £325,000 where they don't have to pay inheritance tax. In addition to that, as long as you've left the house to your children, your direct descendants, you get an extra £175,000 on the house. So that's £325,000 standard allowance, £175,000 on the house, that's £500,000 potentially per person where there's no inheritance tax. In addition to that, if you are married, basically you inherit your spouse's allowances on first death. So that would be basically 2 times 500,000, £1 million. So the typical married couple get £1 million of assets where there's no inheritance tax to pay. So the inheritance tax is 40% above that. So if your assets are above those limits, then your potential tax liability is 40% of that. Just one thing to bear in mind, if you have assets over £2 million, you do start to lose that extra relief on the main house. So just kind of watch out for that and let me know really, because they'll be planning to do around that can kind of reduce your inheritance tax quite quickly. Just let me know really if you have any problems calculating your liability, or if you feel that you need help to see whether you have any inheritance tax issues or not. But that's really kind of a very quick, brief way of just seeing whether you have an inheritance tax problem. So having established that, we need to start looking at potential arrangements and solutions to help perhaps reduce or even eliminate that inheritance tax for the family. So the first thing to do is get your wills organised. If you don't have a will at all, it does mean that the government decide really where your assets go after you've passed away. And those assets might not go to who you want them to go to, when you want them to go to, and they also might be not in the most tax efficient way. So first things first, get your will done, and then you can decide in lifetime who benefits from your estate, when, and you can make it the most tax efficient way possible in terms of your leaving your assets to your loved ones. So get the will done. Second thing you can do is start thinking about making gifts to family members, friends. So you do get some smaller allowances and exemptions which are exempt from inheritance tax immediately. So you get £3,000 per year, which is available to you to make some small gifts, which is exempt immediately. You can also make gifts out of income, which is a little bit less known really, but if you have a surplus income on a monthly basis, perhaps you've got a good pension income or you might have rental income, you can make gifts out of that income as long as you have a surplus over expenditure on a regular basis, and that would again be inheritance tax free immediately. So if you have any queries about that, let me know. We can kind of look through that for you, but that's a lesser known relief that's available to you, exempt immediately. And you can also make gifts out of £250 gifts to any number of people as well. So that's another kind of gifting exemption. Just bear in mind that any gifts in lifetime to charities are exempt immediately. And also if you make any gifts through your will, again, that would be exempt from inheritance tax. So those are the exempt gifts. Now you can also make potentially exempt gifts, which are basically more significant one-off capital gifts. Anybody's allowed to do that. It would be exempt initially, but then you would still need to survive 7 years from the point of gift to make that effective for inheritance tax purposes. There's a kind of a tapering after 3 to 4, 4 to 5 years of that, but effectively you do need to survive 7 years for any gifts to be outside your estate completely for inheritance tax purposes. If you're thinking about making any significant gifts to children, family members, friends, just do make a good record, keep a good record of any gifts that you're making, because obviously if you did pass away before the 7 years, then we would have to bring those back into the estate. So we do need a good records really of any gifts that you're making. Just a quick word on lasting power of attorneys, because we obviously deal a lot with the attorneys. The gifts that you can make are very restricted as an LPA. You know, the underlying rule for LPA is that you have to work in the best interests of the donor that you're working for. So actually gifts are pretty restrictive. Really, you can only make gifts out of customary occasions like birthdays and Christmases, or perhaps some regular gifts to charities that your donor used to make. But really, if you're looking to make anything gifts over and above that, you'd have to go to the Court of Protection to apply, and there's no guarantee that they would approve that. So just a word of warning, if you are acting as an attorney for mum or dad or something like that, that actually gifting is really difficult, very restrictive. So yeah, let me know if there's any kind of anything that any queries that you have, or anything that you want advice on. Really, is if you're an attorney for someone. So that's gifting. So obviously, if you're making gifts of any description, it's coming out of your assets, coming out of your estate for inheritance tax purposes. That could potentially reduce the inheritance tax due on your assets. If you're a little bit concerned about gifting outright assets to family members or to children or whoever, and you do want to maintain some control over those assets, then it might be worth starting to think about trusts. So trusts are basically you gifting money outside your assets into a trust, but maintaining control of those assets. You still decide who gets the money and when. You still have control over those over the assets within the trust. You would still have your regular reviews with myself in terms of any assets or investments that are within the trust. And as I said, this kind of gives you more control. It's more protection against kind of life happening, any future divorces for your beneficiaries, inheritance tax, all of these things, care costs. Lots of different things can happen, as you probably know, in life. But having the money in a trust basically protects those assets from those potential claims from different parties or different things happening in lifetime. So you can set up trusts within lifetime or through the will. And basically there's a trust for every scenario or every situation. So the best thing to do is, if you're interested, or these sorts of things are kind of you're intriguing you, then come in and then let me know what your situation is. So it might be that you don't need access to capital, you're quite happy for the capital to go, but you do still need an income from the trust. So that's entirely possible. You might have grandchildren who you'd like to gift some assets to, but obviously if they're underage, you wouldn't want to give them a big lump sum. So a very common trust arrangement would be to gift capital money into trust to get the money outside your estate for potential school fees or university fees in the future. So you still have control over those assets. You're still deciding where they go and when, but also you're getting the money outside your estate. So that's another common one. And through the will, you might want to leave property into trust. You might want to leave your investments into trust, which again just kind of protect those assets from tax, from care costs, from divorce, from other beneficiaries claiming those assets. So it's just a protective arrangement really to make sure that all of that work that you've done through the lifetime is protecting those assets for the family and can't be claimed or can't kind of disappear out the side door really. So that's trust. I'll do a completely separate video just on trust because there's a lot of different options. But as far as you're concerned, the best thing to do really is just to come in and let me know what your situation is, and I can let you know if there's a trust available for you really. Another potential solution for inheritance tax is a whole of life family life insurance policy. So this is basically for people who want to provide for the inheritance tax. So basically you pay into an insurance policy, generally very good value, in trust. So the policy would be set up in trust, and when you pass away, your beneficiaries just literally pass the death certificate to the life insurance company. They'll pay out a lump sum in trust, and that enables them to pay the inheritance tax immediately. So it's really quick way of organising the whole probate estate process. So what would usually happen is that you would need to pay, or your executors would need to pay the inheritance tax before they can get grant of probate. But the problem with that is if a lot of your assets are in property, or you might have buy-to-let properties, there might not be the liquid funds to actually pay the inheritance tax and release the estate for the beneficiaries. So this is a really quick and easy way of providing for the inheritance tax, gets paid, and then it releases the estate without having to sell homes, houses, or any other assets that are within the estate really. So usually used for people that have got a lot of assets, perhaps properties, but don't have much liquid savings or investments. And as I said, it's a really cost-effective way of providing for inheritance tax from day one. So if you walked out the door and got knocked down by a bus, immediately the inheritance tax is accounted for, provided for. So definitely an option for people. A word on pensions. So since April 2015, pensions have effectively been inheritance tax free. So many people have been using pensions for really like wealth transfer through the generations. So really effective, very tax efficient. Obviously pensions are the most tax efficient investment you can invest in anyway, from all the different other types of tax. But from an inheritance tax point of view, it's completely inheritance tax free. So if you have lots of assets that are available to you, ISAs, other general investments or property income, other assets available to you, use those first because they will reduce your assets for inheritance tax purposes. So really try and retain the assets within the pension as long as you can because of that inheritance tax exemption within the pension. Just look out for some of your older pension contracts which might not qualify for this exemption. So just if you do have older kind of personal pensions or contracts, S32 buyout plans, retirement annuity contracts. There's been a whole load of different types of pension plans through the years. Just let me know, we can have a look to make sure whether your pension plan is inheritance tax exempt, because if not, we could switch it to a more modern plan which does qualify for the inheritance tax exemption. So the next thing I wanted to talk about is business relief. Excuse me. So business relief is legislation which has been going since the 1970s, and originally it was enabled families to pass family businesses down the generations without having to pay death duties. But it's kind of grown really since then, and now it acts as a real incentive really for the government to incentivise people to invest in areas that they want to grow the economy. And basically, if you hold investments or assets or shares in companies that qualify for business relief, those assets are exempt for inheritance tax after just 2 years, which is obviously a very short time frame for inheritance tax planning. Normally you'd have to survive 7 years, if you're making any gifts or doing trust work, whereas here you're inheritance tax exempt after just 2 years, which could really benefit you if you kind of just want to get things done and organised, or you might be in later life and perhaps thinking 7 years might be a bit more unrealistic. So if you're keen to get these inheritance tax exemption done quickly in just a 2 year time frame, business relief might be for you. The other massive advantage is it would still be your investments. So you don't have to make any gifts, you don't have to do any legal trust work. It would still be just your assets that can grow over time for you to be used over time for whatever use you might want to put them to in the future. So definitely worth considering. You can invest your ISA in business relief qualifying portfolios. It tends to be UK smaller companies, usually trading on the AIM market. We have great recommended providers that got a long track record of providing good growth and performance over time. Remember that the investments can go up and down in the short term, but as long as you've got that kind of knowledge and you're comfortable with that, that's definitely an option for you. You can switch ISAs from cash ISAs to investment ISAs to these inheritance tax-free ISAs. So I know I've done a separate video purely on inheritance tax-free ISAs. But you can also invest in business relief assets outside an ISA, in inheritance tax plans that a lot of our recommended providers provide for clients who have inheritance tax issues. So basically you'd have a portfolio of assets that qualify for business relief. It tends to be areas that the government want you to invest in, so it might be fibre broadband, care homes, property, what else, renewables, fibre broadband, just areas where areas that the government want you to invest in really. So you'd have a portfolio of assets that you hold along with lots of other investors. Some of the biggest providers give you a return of 2 to 3%, targeted return of about 3%. So nothing exciting from a return point of view, but more of a stable ride, because these assets then wouldn't be on the stock market going up and down. It would just be fixed assets that are available to you. So again, access is still there. So we only recommend providers that have got a great track record of providing liquidity, to say if you wanted the money back, that you could take the money out when you wanted to. And again, just 2 years time frame for those assets to be inheritance tax free. So again, if that's of interest to you, we can look to see whether those sorts of things are right for you. And then just finally, if you are imminently going into a care home and you're looking to see how to fund your care fees, one of the lesser known options really is an immediate care plan, where you pay a lump sum to the care provider, whether that's a care home or a care provider of any sort, as long as it's registered with the CQC. They can, tax-free by the way, they will pay out an income, tax-free, guaranteed for life, to that care provider. But importantly, for inheritance tax purposes, that lump sum is immediately deductible for inheritance tax. So again, it might be something to consider if you have inheritance tax issues, or you're looking at maybe solving or reducing your inheritance tax as part of your care fund planning, which is obviously a different topic, but something that we can advise you on. So definitely look at that as well. So that's a brief run through of some of the different options that we potentially could look at for you. So wills, gifting, trust work, life policies in trust, pensions, business relief investments, immediate care plans. There's plenty of different options. It might not be just one, it might be two or three different, like a selection of different ones, or a combination of different recommendations. And it doesn't all have to be done at once. It might be just gradually introducing these different solutions and strategies, so that when you eventually pass away, your loved ones, your family benefit from all these assets, and not the government. So really, probably the takeaway is to take action, and the first thing to do really is to book an initial meeting with myself. Just give Laura a call in the office so we can get a time in the diary. Very relaxed in the office. We have a kind of a comfortable living room style format office where you can ask us questions, we can explore your situation, and we'll just lay it out for you really, just to see what kind of options might be available for you and your family. I'm quite happy to see your family as well. That's a big part of what we do, is to kind of get to know the family, to make sure that everything you're doing is in their best interest as well as your own. So definitely get in touch for that first meeting. Thanks so much for joining me today. Hopefully it's been useful for you, and we'll see you next time. Okay, cheers, bye bye.